Hello, welcome back, guys. We're taking a bit of a look at a company that may not ring a bell if you take a look at this name, VF Corporation. But if you examine our company profile page here, you will see that this is a company that actually houses products under the North Face, Timberland, Smartwool, Icebreaker, Ultra, Vans, Supreme, and other well-known brands here. So it is a very well-known company, frankly, or at least it has some very well-known brands. And so the question is this an interesting company to be buying right now? Is this a good purchase? So we're going to be taking a little bit of a look at that. Now, as I've talked about in the past, while I do like having some retailers in my portfolio, I would stay a little bit vigilant about adding more right now, and I would want to have just some of the best ones. Now, if this company doesn't really fit my profile of having some of the best ones, I would just avoid it for now. But at this current market condition, where we could be heading for an even steeper downtrend, or at least one that lasts for a while, I would just want to be having all these companies that have been doing well, and they have little debt and not too much inventory that they would have to fulfill. So these are some of the requirements if I were to be buying a retailer, and also I would want to be getting it at a very cheap price. Now, the P ratio of the company has been at 17, and the price to free cash flow at 32, about double that, which means that the company's earnings do not really lead to great free cash flow here, or at least not at a similar rate. And this can be a little bit problematic, especially when we are examining the payout ratio in regards to the free cash flow that the company generates. It may be not enough, for example. We will examine that in a little bit more detail when we take a look at the financial statements. But you will see that the company has been buying back just a little bit of shares over here, just about 3%. And they do have quite a significant amount of total liabilities here when you compare it to the free cash flow that they generated. So we will examine that as well. Now, the revenue that the company has been having hasn't been growing a ton, but the net income has been growing. And they did have some slump here, sort of, but overall they have been growing their net income, but the free cash flow hasn't been growing at the same pace. It has actually been going down pretty much, and the same thing with the total equity here. Now, you will see that the net income margin is at about 4.4% here, and seems to be going down. It used to be more than that. And in terms of the returns on equity, sitting at about 15%, 14-15%. An interesting thing to see here, the company is paying 4.36 in terms of the dividend yield right now. You can take a look at the dividend stub, and you will see that the company has also cut down on dividends at some point. So if things get worse, potentially, you could definitely easily see them cut down even more on the dividends that they are paying. So this may be a little bit problematic for holding such a company. It may be a little bit scary, a little bit risky here. Now, if we take a look at the metrics page, you will see that the company's market cap is sitting at 17.35 billion. And if we take a little bit of a quick look at our cash flow statement, which really matters to us, we'll see that the company generated about 500 million in terms of free cash flow, that is last fiscal year. And so we go back here at our metrics page, but we can do a very simple calculation here. We can just get the market cap of the company, out of which the company pays let's just say 4.36 in terms of the dividend yield. So what we can do is we can have our calculator here and do this simple calculation. Go like 17.35, which is the market cap, and then multiply that by 4.36, let's just say, and then divide by 100, which gives us $0.75 billion that the company pays back to shareholders, to stockholders. This is 756 million, as you can understand. And remember, the company was generating about 530 million in free cash flow, that is last year. And so this is why the free cash flow payout ratio is very high. And even if we go back to our financial statements here and take a look at the cash flow statement, the company did do $1 billion the year before that. But then again, they did 540 million and then 1.3 billion. So on average, they are probably sitting at about close to $1 billion in terms of the free cash flow that they generate here, which is it is okay, but it's not enough to be fulfilling their dividend payouts easily. That is the big problem that I'm seeing here. And so This can potentially prompt and have the company actually eventually cut down on their dividends, which can be very, very problematic for somebody holding the company. This is why this payout ratio alone could easily deter me from purchasing the company, which is already not very cheap as well. Remember that the price to free cash flow is still already kind of elevated. And also the total liabilities of the company. We take a look at our balance sheet here, and you will see that the current total liabilities of the company are about 10 billion. And when we examine again the free cash flow that they generated was 500 million, which takes us to about 18 to 20 in terms of the ratio, the rate between the ratio between the free cash flow and the total liabilities, 18.3 pretty much. So this is high for the debt that the company has, as you can understand, and we cannot really be wanting to add this to a portfolio so easily because there are some risks here. It is not as cheap. It has a lot of debt, which is not the best thing to be seeing in this current market, something that I don't like to see. And it's also quite some compared to the equity of the company that the company has as well. Plus, they have a dividend that is not easy to fulfill, high free cash flow payout ratio here, which really matters. I mean, the dividends are paid out of free cash flow. So things are not looking great. And another thing that I kind of caught my attention here was when I was taking a look at the cash flow statement, I noticed an outflow in terms of the change in working capital here, which may not be broken down here, but it could be, for example, accounts payable. So the actual the company actually paid some suppliers, for instance, like prepaid some suppliers, and so they actually removed some of their cash in their reserves. This means that the company may have actually pre-allocated some extra inventory that they may not be easily able to sell in the future. And so they have been, pretty much utilizing some of their capital in some inventory that they may be having some trouble selling potentially. Now, this doesn't seem to have been the case in the latest report, but in the previous fiscal year, pretty much report. But it may be troublesome for the years to come for the company, or at least for the quarters to come, because again, we could be having a little bit of a slump in terms of retailers. So for these reasons, I would be a little bit cautious about adding this one to my portfolio. And I do think, frankly speaking, that there are better opportunities, better retailers to be adding if you really want to be buying some retailers. This just doesn't seem to be one of the cheap ones and one of the retailers that I would have in my priority list for potentially adding to my portfolio here. Now, as usual, I will take it to our stock evaluation tool, which can help give us an idea. But remember, for retailers, you could be easily getting some green prices, and then still you need to value the overall behavior of the company, the things that we discussed already, in order to see whether it makes any sense to be buying this one, because this is a more risky game right now for retailers, and you need to bear that in mind. It's not as risk-free as buying some other companies potentially. I mean, there's nothing risk-free, but I guess less risky is the correct term. Now, the revenue growth of the company has been a little bit all over the place, but the last 3 years has been 6%, last 5 years about 1%. So I'm gonna go a little bit in between. Maybe that's a little bit aggressive too, but I'm gonna go, let's just go 1, 3, and 5. This may even be a little bit aggressive, yeah. In terms of net income margin, they have been going down recently, as you'll see. But overall, I'd say maybe something like 6, 8, and 10. They are all over the place. I mean, we have seen like the last average has been like 4.4, then the last quarter has been 11. So things of that sort have been happening for the company the last fiscal year, that is. So this has been a little bit all over the place in terms of the net income margins that the company has been generating. If I quickly jump back to here, you can kind of see it being going down through the past few months. But overall, you can see that in the fiscal year, remember, fiscal year doesn't end necessarily in December 31st. This is like a 12-month period. Lately, it has been going up a little bit, but before that, it was down, then it was 6%, then 12%. It has been going a little bit all over the places where I mentioned earlier. So that was 1, 3, and 5 here that we used. Yeah, let's just go 6, 8, and 10 here, I suppose. And in terms of free cash flow margins, we could use something that is, again, the company a little bit all over the place. We can use something that is closer to normalcy, 80, 90, and 100. an annual return of 13%. We already examined that the company is not great with generating free cash flow, so this may again be a little bit of an aggressive target. When we hit calculate with these numbers, then we are seeing that is our high estimate that is close to our current price. Our medium one is still far and our low one is also far. So for these reasons, and because these are already some, even the medium ones can be tough to achieve, I wouldn't be inclined to be adding VFC right now to my portfolio. Even though the brands are very well known, it does seem like there could be better opportunities right now, even in the retailer space, which regardless of what we're seeing in this company, is a space that I want to be super cautious about these days. So I only want to be getting some of the best ones. Some of the companies that we have talked about in the previous videos, which I liked, Best Buy, Crocs, were some of the retailers that I found to be in the top tier of my selections. But this one, I think it's not time yet. But do tell me what you think about the company, and remember to leave a comment and like the video if you did enjoy this one, and subscribe if you're not a subscriber already. Also, you can always become a Patreon and gain access to this too by visiting the link in the description box below this video or directly visiting myinvestorsheaven.com. I'll see you in the next video, guys. Bye bye.